have completed with the functions of Reserve Bank of India. We have completed around 9 functions different. Moving on to the very important topic of RBI, monetary policy of Reserve Bank of India. The policy adopted by the RBI to control the money supply in the country is called as monetary policy. To achieve monetary stability, the RBI has wide powers to control credit by exercising various measures like quantitative and qualitative credit control measures. Now, as we know, monetary means what? Money, right? Monetary, money supply, right? The entire aim or goal of monetary supply is making sure there is a price stability with growth. Okay, how does RBI control the money supply? Is to make sure there is a price stability in the market along with growth. Because every step the government takes, every decision it's going to take, maybe in the parliament, in the budget, etc., all these decisions must lead for the development of the economy, correct? So therefore, in order to control the money supply, government need to focus on what? Price stability with growth. Price stability is the necessary precondition for a sustainable growth of the economy. Unless prices are stable, economy will fall, right? If the rupee value is going on decreasing or increasing, it is unstable, then the economy really cannot develop, economy will fall. But if there is price stability, if the prices are maintained, but yes, monetary stability can be achieved. Okay, so how prices of commodities have risen? Now we can see that the prices of commodities and services have been sharply risen. If you can observe, if it is risen, then it is due to increase in demand. People are demanding certain products or goods, or there is shortage in supply, there is scarcity, there is only few goods left out in the market and people are after it. Okay. On the other side, if we can see prices are falling down, that means prices have drastically decreased of commodities and services. One can be it is because of there is too much of supply, there is oversupply and there is not much demand for that products. Let me repeat that. When the prices of commodities increase, it can be due to increase in demand or shortage in supply. Got it? On the other side, if the prices of commodities and services are decreasing or drastically dropping down, it can be because of oversupply and lack of demand. These can be the two opposites of money or the rupee value increasing or decreasing due to the change in demand and supply. Now, we commonly talk about inflation, correct? Now, what does inflation means? It is the rate at which the price of the commodity increases over a period of time. I repeat, inflation, what is it? It is the rate at which prices of commodity what? Increases. Inflate means what? In a normal sense, inflate means higher, increase. So, inflation means commodities prices are increasing. Does it increase one shot overnight? No. Over a period of time it increases. It can be due to increase in the population. If population increases, there are more number of needs and demands of people increasing. In order to meet those people's growing demand, there is also supply increasing. So, due to all these factors, the prices of commodities increase. In simple sense, if you want to remember, ma'am, what is inflation? In one sentence, it is more money chasing fewer goods. Okay, in one shot, what does inflation means? More money chasing fewer goods. Now, if you have to observe where vehicles or two-wheelers or four-wheelers were introduced in India, right? Now, if we can observe directly with the increase in production of vehicles, directly my petrol or diesel prices also will impact. Yes or no? You can buy a car, you can buy a lorry, etc. But can you run without petrol or diesel? No. You need a petrol or diesel to run your vehicle. It cannot sustain without petrol or diesel. So, it is a simultaneous increase. Production of vehicles, along with that, petrol prices also will increase. So back then when they were introduced, we can see, if we can talk to our grandparents, they would say, in our days, like in early 90s or 1940s, the prices of petrol may be just 70 paise per liter or 75 paise per liter. I'm not talking about rupees, guys, I'm talking about paise. But now if you look at today Bangalore, what is the petrol prices? It almost reaches to 83 to 85 rupees, almost 85 rupees per liter of petrol, correct? So what has this caused the huge increase from paise per liter? Today it almost reaches up to 85 rupees per liter. Can you see the difference? Can you see the difference in the increase in the prices of petrol? This is called as inflation, right? Now if you can see, a cup of ice cream maybe costs rupees 100. Okay, now if you're going to, same thing we tell our grandparents, a cup of ice cream is rupees 100, they would tell, in our days we would run the entire household expenditure for one full month at rupees 100, correct? So that was their cost of living, their expenditures, their standard of living, etc. What prices their commodities were priced in their time period. To compare to now 2020, how far the prices of commodities have increased. So here monetary policy is aiming to get these prices under control. Is that clear? To maintain the stability of prices of commodity and services. Hope you understood what is monetary policy, what is the aim of monetary policy, that is price stability with sustainable growth. Now in order to establish this, the objective, it has two major measures: quantitative measures and qualitative measures. So today we are going to look into the qualitative measures of monetary policy, under which we have three major points: bank rate, open market operations and variable reserve ratio. First one, bank rate. It is the rate at which the commercial banks borrow from the RBI. An increase in the bank rate to be effective, the commercial banks should resort to the borrowings from the bank. Now what is bank rate that we have studied under bank ratios or rates? It is the rate at which commercial banks borrow from RBI. Okay. Now why does it says an increase in the bank rate? Now let's say currently, for an example, a week back, let's say the bank rate was 5%, example. Now commercial bank wanted to borrow from RBI, but today the rate stands at 7.5%. That means there is a increase in the bank rate. Now what would commercial bank do? Would it continue to borrow? Now when they borrow from RBI, it's not that the entire amount which they borrow, they will return back the same amount. Of course, Reserve Bank of India will charge interest on the amount borrowed. Therefore, commercial bank, will it borrow now? Banks should resort, read the last line, banks should resort to the borrowings from the bank, that means from the RBI. So whenever there is an increase in the bank rate, commercial bank will think twice about whether or not should it borrow from RBI, or it should learn to manage its own deposits or its own money supply in the commercial bank. Is that clear? Now if they always constantly start to depend upon the Reserve Bank of India, just because RBI is a lender of last resort, then banks will end up paying more amount of interest. Yes or no? So therefore, by increasing the bank rate, it is one of the primary steps taken up by the RBI, that commercial banks would learn not to depend upon the RBI, but learn to use its own funds efficiently. Is that clear? Being taking care of the deposits, their investments, their other ratios, how to tackle non-performing assets, how to tackle the deposits or gold investments, etc. All these operations, they have to be able to run efficiently without having the thought of borrowing from RBI. Is that clear? That is the first step under the qualitative measure, by increasing the bank rate. The second one, open market operations. The RBI Act authorizes to engage in the purchase and sale of securities of central and state government. By sale of cash base of banks decrease, and by purchase the government cash bases increase. Now open market operations means that government or the RBI Act has the authority what? To engage in purchasing of securities or selling the securities of whom? Central and the state governments. Is that clear? So when commercial banks start to purchase treasury bills or other government bonds, what happens? The cash base of banks decreases, because let's say I have 1 lakh rupees as a commercial bank. If I deposit that 1 lakh rupees as a treasury bill or as a government bond security that is owned by state or the central government, what happens? The money in my hands what? Decreases. And the other side, by purchase, government cash bases increase. So that money, where is it going? It is reaching the other side of government. Is that clear? So by open market operations, by when the government sells, the cash balance with the bank decreases and the cash balance with the government increases. Now there are two major objectives with this. The first one is long-term objective, to create wide and healthy market for government securities. Second, to assist monetary securities in the interest of public debt management. So long-term objective is what? Wide and healthy market for government securities. Now if commercial, instead of government selling its treasury bills to individuals like you and me, right? It is not, we are not much secure in our financial background yet. Yes or no? But if I compare our financial stability as individuals compared to commercial banks, who is more stable financially? Of course, commercial banks are more stable. So that way, the long-term objective is to create wide and healthy market for government securities. So tomorrow, we know that commercial banks are as a backup for India or the monetary policy of India. Correct? So if government needs money, right, or if government wants to raise money, it can issue treasury bills, it can issue bonds in the form of open market operations, and the government is ready to sell those securities to commercial bank, institutions, and yes, individuals also can purchase. But if institutions purchase, it is more secure. Why? To create wide and healthy market. So government itself wants to involve in the form of Reserve Bank of India to buy and sell securities, so that this would become a habit, or this would become the process of operating the money supply in the economy. How can I collect? Simply in the form of taxes. Government always cannot take money, correct? So there are other forms called as market operations. That way government will, in the long term objective, is going to start building a wide and a healthy market for government securities. The short term objective, to assist monetary securities in the interest of public debt management. So you and me, or as an individual, institution or a company, we always look for secure mode of investment. Yes, banks are secure, or you have what are the other investment avenues? We have mutual funds, we have LIC, we have gold, right? We have so many other post office savings, so many options for investment. But while we are choosing government securities, it is more secure. Our investments are more secure. For an example, if the same money, whatever savings I have, if I put it into a purchase an equity share of a company, okay, I become the owner of the company, I enjoy the rights of the company, etc. But if the company turns out to be a fake company, overnight the company has been declared as a fraud company or as a unethical company by the government of India or by the court of law, all my money is gone. Correct? No matter how good or how well the company is performing today, we are still risky about companies' operations tomorrow. Tomorrow the market may fall down, or tomorrow I might lose my entire share market in the company. Anything can happen. But today I might be earning well. But that's not the same with government. Can government run away? Can government shut down overnight? Can government become insolvent? No. Right? So my short term objective is to what? Assist the monetary securities in the interest of public debt management. So I am more secure, and my money or my investment into government securities are more secure compared to any other private institutions. Now if you say, ma'am, a private institution offer us higher interest rate than compared to government, yes, agreed upon that. All the private institutions always offer you a bit higher percentage of interest compared to all your government standards, or I would say government securities. That is just for attracting more of public towards private institutions. But then the point is, what is the stability of the income? Today you might get higher interest, and the next year the company says, we are working on some expansion of company, we will not be able to give you the same return on your investment, right? They might push. That means there is no stability in the income. But in the government securities, even though it's a lower rate of interest, that which is compared to private, there is stability of income. If they are paying rupees 1000 per year, that will be stable. Okay, that of course it won't increase or decrease, it will be stable across the for whatever time period you have invested. On the opposite, private, it's different, right? Whenever there is profit, they might pay you higher. If there is no profit, you have to bear with the loss. There is no any other way. You just have to sell out your shares. But government, there is stability. So by this operations, the public increases its faith or security in the market operations of government. Is that clear? So that is to short term objective. Under open market operations, it has two objectives. One is to create wide and healthy market, and second is to assist the monetary securities in whose interest? In the interest of public debt management. Is that clear? The last one, variable reserve ratio. The commercial banks have to maintain a minimum cash balance with the RBI. By varying the reserve, RBI could undertake qualitative control effectively. A minimum cash reserve of 5% of demand liabilities and 2% of time liabilities. We already have learnt about this, right? What is demand liabilities and what is time liabilities? Demand liabilities means what? Savings and current account. There is no limit as to how many withdrawals or how many deposits. It can be as frequent as possible. That is called as demand liabilities. Any time customer can come and deposit or withdraw how much ever amount he may wish to. There is no restrictions on that. Whereas time liabilities, time means it is attached to time period. That is your fixed deposit and your recurring deposits. A customer has opened an RD account for the next 5 years, and the bank is assured that for the next 5 years I don't have to worry about the repayment of this RD amount. You got it? So that is called as time liabilities. So variable reserve ratio means, now here it is saying a minimum cash reserve of what? Out of the total demand liabilities. If you put up let's say example bank X. This bank X total demand liabilities are, let's say, 5 lakh rupees. Out of that, 5% must be kept with whom? RBI. That is total of current and total of savings put together becomes demand liabilities. On the other side, 2% of time liabilities means total of FD and total of RD put together, 2% of that must be kept with RBI. Now, variable reserve ratio means what? Anytime this ratio mentioned that is 5%, 2% may change. Understand? RBI, by varying the reserve ratio, could undertake qualitative control effectively. The bank RBI is not doing anything much. It's just changing the ratio or changing the percentage. By changing the percentage, a lot can happen with the money supply with the commercial bank. Yes or no? Slightly increasing this 5% to 7%, more money will remain with RBI and lesser money with commercial bank. Automatically the credit control measures will be under control of RBI. On the same side, if 5% it decreases to 4%, again there will be more money with commercial bank and less money with RBI. Is that clear? That is called as variable reserve ratio. Commercial banks have to maintain this ratio as according to the changing ratios time in and time out by the RBI. Is that clear? So this completes our qualitative measures, that is bank rate, open market operations and variable reserve ratio.